This is Financial Management 15, and it should be relatively short lecture. We complete chapter 6 on interest rates. And we begin section 1 discussing cost of money. So on section 1 we said that there are 4 fundamental factors determining interest rates. These are investment opportunities. These are savings. That's section 1. I'm just reviewing section 1. Savings or time preferences, risk, and inflation. That was section 1. Then on section 2 we discussed interest rates levels, where interest rates cycle for many years with low interest rates, and then for long periods with high interest rates. They could be as low as 1-2%, or as high as 15-20% on the short term, on the long term, depending on circumstances. In section 3, we covered the determinants of interest rates, and we said the primary determinant of interest rates is the risk-free interest rate, which is depending on saving and investment opportunities, and the risk components. One component is the inflation risk, and the other types will be liquidity risk, default risk, there may be currency risk, and so on. And that's section 3. We further said that each type of risk will have a premium. So inflation risk will have inflation premium. Default risk will have a default risk premium. Okay? Interest rate risk, they call it maturity risk premium. Okay? Or interest rate premium. We sometimes call it volatility premium, however you like to call it. And then we discussed last lecture at great length term structure of interest rates. That term structure could be upward sloping, downward sloping, it could be steepening, it could be rising, it could be falling, it could be flattening, the different types of yield curves. And then we had a short discussion, which is section 6.5, on what determines the shape of the yield curve. And I basically explained, and let me now write it out. Depends a lot on the economy. If the economy is strengthening economy. So if the economy is getting stronger and better and GDP is rising and accelerating, you would expect yield curves to be rising. So we're going to have rising yield curve. So yield curves will be rising with a business cycle, but not just rising. You'll also have the yield curve steepening. In other words, as the economy gets stronger and better, the yield curve would rise and steepen. It is driven by investment opportunities. So this is caused by strong economy, by investment opportunities, as investors want to invest more and more, and rising inflation. So investment opportunities and rising inflation and inflationary expectations. Okay? The opposite is true. Weakening economy, you'll expect the exact opposite. You'd expect falling. Yield curve as interest rate opportunities fall and as inflation expectations fall. Of course, you'd also expect steepening to become flattening yield curve. It's actually both at the same time. It both falls, and as it falls, the long term falls faster, and the yield curve gets flatter. Well, when economy gets weaker and weaker and weaker, steep curves get flattening, and later on it gets flat, and it's possible for the yield curve to invert, okay, or become downward sloping. So instead of weakening economy, let's use a new term that's not very, they call it recessionary economy. Recessionary. Is a weakening economy which is likely to enter a recession or is already in a recession, okay? So when the economy, as it weakens and the yield curve flattens, it can actually happen most of the time that a recessionary economy will bring inverted yield curve. And this is used by economists for forecasting purposes. How? By observing the yield curve. You can actually observe every single day the yield curve. You just can look at it 3 months ago, 2 months ago, this month, today, and you can say, is the yield curve rising or falling? If the yield curve is falling, it's a weakening economy. Is it also flattening? Sure, it also is an indicator of a weakening economy. And one of the most reliable indicators or predictors of recession is inversion of the yield curve. Basically, they are saying that inverting or inverted yield curve is a guarantee for a recession. Every time the yield curve has inverted, it has certainly led to a recession. Okay? So, when you see an inverted yield curve, it's very easy to say, okay, the economy is about to get into a recession. Now, it does not mean that every recession leads to an inverted yield curve. Okay? But every inverted yield curve always forecasts recession. It is extremely reliable indicator of a weakening or recessionary economy. Okay? And this is an explanation of 6.5. When you go on page 165, it says, a downward sloping yield curve often foreshadows an economic downturn, which I just call recession, okay? So this is, let's write it out, page 165. Page 165. This is what I was explaining so far from 6.5. Okay. Using yield curve to estimate 6.6. 6.6 is about forecasting future interest rates. This is page 167. I have taken me a short note when I was doing my homework to prepare for class that I would be skipping this section as too unnecessarily complicated. All I can tell you is something very simple. When you observe yield curves, it is possible to predict or to forecast future interest rates. As you observe the yield curve flattening or steepening, again, rising or falling, depending on the, we call it dynamics of the yield curve, it is possible to forecast future interest rates. Future interest rates actually will be incorporated into the yield curve, and the yield curve is considered to be so far the best market indicator of future interest rates. So if you're asking a simple question, what's going to be, or what is the expected interest rate 2 years from now, the way to do it is you look into the yield curve, and there are basic calculations which I don't even want to get into. But the idea for you to understand is that they don't just, suck it out of their finger, they just make it up. They actually look at the shape, the yield, the dynamics, and based on that, they have incorporated, the yield curve incorporates it, and there is a way to basically get back what is the expected interest rate for each successive year, okay? And that's section 6.6. And now we're getting to 6.7, which is, and I have been discussing back and forth, and I've been mentioning over the last 2 lectures or 3, macroeconomic factors. Which happened to be, from many lectures ago, Mario's question as to what determines interest rate? How do we determine interest rates? And I gave you the basics were investment opportunities, time preferences, also savings preferences, inflation expectations, and risk. So the question is how the macroeconomy determines these. In other words, what can we be looking in the macroeconomy? And 6, 7, 8, wow. Okay, I'll use red. 6, 7, 8, monetary policy. This is, let me write it out in basic color, 6, 7a, chapter 6, 7a, on page 170. And I have been already spent the previous lecture when I was basically telling you that monetary policy might be stimulative, and the Fed would be trying to push interest rates down to provide a stimulus for the economy. Alternatively, monetary policy could be restrictive, where the economy is booming, growing too fast, inflation expectations are rising, and inflation is heating up, and central bank will try to raise interest rates in order to slow down inflation. So monetary policy will be to a great extent determining interest rates. Of course, monetary policy can't always determine liquidity premium, although, as we studied over the last 4 years, the central bank could possibly provide liquidity injections in the economy to ease liquidity conditions in the liquidity premium. The central bank can not affect much default premium, okay? But by providing more easy credit, they can lower to a great extent default rates and default risk premium. So monetary policy for sure will determine risk-free interest rates, okay? It will for sure determine inflation rates, as in they could ease and have a stronger, in other words, accommodating monetary policy will result in higher inflation expectations, or restrictive monetary policy lower. So monetary policy is the first most important macroeconomic factor that affects and to a great extent determines the levels of interest rates in the economy. And that's 6, 7, 8. Six, 7, B. Fiscal policy. 6, 7, B. This will be page 171. Textbook says federal budget deficit and budget surplus. Of course, fiscal policy determines budget deficit. So, what is fiscal policy? Fiscal policy is government policy on spending and taxation. In other words, on government revenues and government expenses. And the budget deficit is simply the difference between spending and revenue. So, depending on how the government decides to spend, and tax will determine budget deficit. And budget deficits in turn determine government borrowing. Okay? So, if government runs higher deficit, it must, one way or another, cover the difference with borrowing, with higher borrowing. So larger deficits results in larger borrowing. And larger borrowing means the government must, how do they borrow? Sell bonds. So it will result in the government selling more bonds on the market. So government borrowing, higher government borrowing results in selling more bonds. So when government sells more bonds, it means that prices of bonds will fall. So government's going to push bond prices down and will, again, we had this relationship from the very beginning of the course, interest rates up. Let's provide an example. When we were discussing the global financial crisis, we began the second video that led from BBC Love of Money, that led to the global causes of the global financial crisis. What they indicated there was that Greenspan was advising President Clinton that President Clinton should run budget surpluses. And if they run budget surpluses, the markets will love it, and the markets will push interest rates down. And what they indicated was this is exactly what actually happened in the 90s, especially in the late 90s, during the Clinton-Greenspan era. Clinton ran surpluses, supposedly paid down fiscal government debt, and that resulted in bringing down in the 90s both short-term and long-term interest rates down, and this resulted in a major economic boom. You had a stock market boom, investment boom, dot-com, telecom boom. So this turned out to be a great political and of course economic move for Clinton, as reducing deficits resulted in lower interest rate and stronger, well, supposedly stronger economy, because they created an artificial boom which resulted in 2001 technology, tech, telecom bust. It's a whole different story. But it's important to understand that fiscal policy matters. So, monetary policy determines, fiscal policy determines. 3, international. Factors. Remember, for the global financial crisis, blame the Chinese, right? All right, well, what's international factors have to do? Well, international factors, let's write it more specifically, will mean capital inflows and outflows. Capital inflows and outflows. Now, remember what the story was? The story was that the Chinese were running huge surpluses, trade surpluses. They were having a high savings rate. They were saving a lot of money and investing it in the United States. For the United States, this means that capital inflows, they had capital inflows from China. In other words, Chinese capital was moving to the United States, and when capital comes in other words, savings come in, the savings push down interest rates. Remember now what was Greenspan's story. Greenspan's story was, excuse me, we, the Fed, had a control over the short-term end of the yield curve. In other words, we could determine the short-term interest rates, but we had very little control over the long-term interest rates, and it was the Chinese fault, meaning blame China, because the Chinese pushed down the long end of the yield curve. And they said, we were powerless and we couldn't do anything because that was out of our control. We could not control the yield curve. Okay? And therefore, it's not our fault. Blame the Chinese. So easy. But, let me see if I have it over here. Just a couple of years later, the story changes. Oh, we got Operation Twist. But what's Operation Twist? Operation Twist is central bank exerting or using monetary policy to affect long-term interest rates. So, question for Greenspan. Which one is it? Is the Fed unable to affect interest rates, long-term interest rates, or is the Fed able? Well, suddenly now we're discovering that the Fed is actually able. It can conduct monetary policy so as to affect long-term interest rates in the desired direction. So, when it's convenient and useful, they said, yeah, of course, we can, bring down interest rates and use monetary policy tools. But when it's inconvenient, they said, no, we couldn't do anything. It wasn't in our control. Blame the Chinese. So, which one is the answer? And the answer is simple. Of course, the Fed can at any time, if they want to, and if it's in their interest, affect both the short term and the long term. And blaming the Chinese is simply an excuse for bad monetary policy. It's not the Chinese fault. It was a bad monetary policy in the first place, but having seen how bad the policy is, they're never going to say, sorry, it's our fault, we screwed up. They're going to say, oh, it's the Chinese, it's terrorists, remember, it's whatever, somebody else blaming on it. So, very important to understand, back to our topic, that there are a number of factors like capital inflows and capital outflows. The second very important factor is global interest rates. Well, if global interest rates change, they will affect domestic interest rates. For example, if interest rates in, let's say, Australia rise, you're going to say, I don't want to invest in 2% in US. I'm going to move my money over to Australia. This will result in selling bonds in the US and buying bonds in Australia. When you sell bonds and bonds, you will push up interest rates. So, if Australian interest rates rise, it will result in selling US bonds and pushing up US interest rates. Okay? So, rising Australian interest rates as an international factor will result in rising US interest rates because capital will flow out of the US and flow into Australia or Canada or Singapore or China or whichever country has got rising interest rates and, free capital flows policy. So global interest rates do determine local or domestic interest rates because as global interest rates change, capital will flow out or flow back in depending on the circumstances. And there is one other factor is part of all of this, and these are trade deficits. Trade deficit simply means you export less than you import and you need to finance. In other words, you need somehow to, it's called raise capital in order to finance. So a trade deficit acts very similar to a budget deficit. A trade deficit, in other words, needs to be financed and it needs to be financed from foreigners. So a trade deficit will increase, we call it now foreign borrowing. Foreign borrowing. And rising foreign borrowing, borrowing from foreigners, will naturally push domestic interest rates higher. Okay? In other words, you need to attract more foreign capital, and you do attract foreign capital by raising your interest rates. So, if you want to attract Chinese capital, you got to raise your own interest rates. The alternative is Chinese are eager to invest in the United States, and if they do that, they push down interest rates. Okay? So, when capital flows from China to the US, the question is what's the effect? And the answer is depends who initiates. If Americans want to initiate the capital inflow, Americans got to raise their interest rate to initiate or to stimulate Chinese to shift capital to the US. On the other hand, if Chinese initiate the move, it's going to result in falling interest rate. So you can't say as capital flows in whether it's going to result in rising or falling interest rates because it's not clear whether domestic factors triggered the capital inflow or foreign factors triggered the capital inflow. Here's an example of foreign factors triggering capital inflows. We got the global financial crisis. Europe is in trouble, like in deep trouble. Investors scared of investing in Italy, in Portugal, in Spain, in Greece. These are all bankrupt governments. And if these governments really go bankrupt, as they are likely going to go, you don't want to invest in their banks too. So what do you do as an investor? You take your money out of Europe and move them somewhere safe, either in Asia or in the United States. So what you have is a capital outflow from Europe. So capital flows out of Europe and flows into the United States. Because of rising risk in Europe, investors move capital from Europe, and by moving capital out of Europe, they push down interest rates in the United States. So this is an international factor which is driven by capital inflows, but the capital inflow is simply a result, is caused by capital outflow from Europe because of, it's called flight of capital. Okay? Chinese were eager to invest in the US, and that's how they push interest rates. In Europe, now the situation is the opposite. They don't want to invest in Europe, and they move to US because there's no other better place that can absorb all the capital. I mean, how much capital can you invest in Taiwan? How much capital can the Taiwanese economy absorb? Yes, there's not much. It's too little relative to the French, German, and all the size of all the capital. Okay, so that's 7.4c. And the last one is number 4, which is like the last one. So I'll do here number 4. And number 4 is business activity. Instead of business activity, I'm going to say red, business cycle. And business cycle is the same as growth, in a sense. Economic growth. Is the economy growing or not growing? This is what I've been talking here. Is the economy strengthening, or is the economy weakening, or is the economy recessionary? So, in a sense, economic growth and the strength of the economy determines also interest rates in combination with monetary policy, fiscal policy, and international factors. Okay? So, this will be mostly determined, economic growth will be determined effectively by the business cycle. As the business cycle moves up, and you have a strengthened economy, you're going to have one type of interest rates, and as the economy weakens, you got the other type of interest rates. And that completes the macroeconomic factors determining interest rates. And 6.8 is a simple one-page section which says interest rates and business decisions, and it's amazingly simple. As interest rates fall and remain lower, businessmen are more willing to borrow, and as interest rates rise, businessmen are less willing to borrow. Okay? So, falling interest rates provide incentives for businessmen to borrow, and rising interest rates provide this incentive to borrow. That's the main reason that as economy weakens, the central bank would like to lower interest rates in order to provide businessmen with incentive to borrow more and make more investments, as well as provide consumers with more incentives to borrow and consume or borrow and maybe invest. Invest in education, invest in a house, or maybe borrow to buy a car. In other words, the central bank will be lowering interest rates in order to stimulate borrowing, which will be used either for consumption by consumers or investment by businesses. And that's how interest rates affect and determine business decisions. And when we say business decisions, means decisions to invest or not invest, borrow or not borrow. All right? And that completes the lecture in the chapter on interest rates.